welcome to this week's Market Matters video update. It's the 6th of October. Today, we're almost a week into the new quarter, and we're going to talk about performance of September and the quarter just gone, the first quarter of FY22. James, ASX was down about 2.7% in the quarter. S&P was a little bit worse. How did we hold up in the Flagship Growth portfolio, James?
Yeah, it was, September is a month of weakness from a seasonality perspective. We generally see that play out. Obviously, a lot of stocks locally go ex-dividend, which adds to the price weakness amongst stocks there. But so the ASX 200 fell 2.6. So keep in the context of what our portfolios have done against that backdrop. So 2.6% for the ASX 200. If you include dividends, so the accumulation index, that dropped 1.85%, so slightly better. The growth portfolio had a really good relative month. It added 0.56% for the month. So we're really happy with that result, given the volatility that played out into September. Obviously, holding the right stocks, the right sectors, played into our hands there. We're overweight the materials space. That actually didn't do that well in September. The material space is weighed heavily to iron ore, so iron ore was under pressure, but we held a lot of a number of positions that are outside that iron ore bulk commodity space that that did better. So that did us well in that regard, Harry. And I guess one of the things that I really look at and really treasure, I guess, from a portfolio perspective is downside capture. So trying to capture less of the downside when it plays out, and that can really help underlying performance as we move on. So a good September builds on a strong quarter for the start of the year. Obviously plenty more time to run, but we're happy with how things are going for now.
You mentioned dividends in that comment there, James. The income portfolio, how'd that hold up relative, given that there was some dividends getting paid in September?
Yeah, this is a portfolio that's all about consistency. So consistency in income being paid, but also consistency in returns throughout the year. So we want to see this portfolio hold up when volatility ticks higher, and we do that by holding the type of stocks that we hold in the portfolio, plus also the composition of the portfolio. So this is made up of equities, hybrids, and bonds. So it has more diversity than our growth portfolio. Happy to say that it held up relatively well in September. It was up 0.05%, so a whisker up on the period, Harry. But that's a combination of income as well as some marginal capital loss gives up that aggregate return, which is slightly positive. So exactly what we want to see. I mean, I'll call out a couple of things that happened during the month in that portfolio. We added alumina. We actually added alumina AWC into the growth portfolio as well. We think that stock has really strong commodity price tailwinds at this point in time. Smart Group, which is the novated leasing salary packaging business, copped a takeover bid at the end of the month. That was up 19% or thereabouts over the period. So that was obviously beneficial to the portfolio. And we added APA Group at the back end of the month. APA Group's an interesting infrastructure play. It's a regulated infrastructure play. A couple of corporate things they've got on the go at the moment has put some downward pressure on the share price. But we like this infrastructure theme for this sort of portfolio moving forward. So APA Group is one that I'd still be happy to buy out there, Harry.
Yeah, definitely. You spoke about some volatility there, James. How's that looking for the emerging companies portfolio?
Yeah, well, this is your portfolio. And I've got to say, this was our strongest portfolio for the month, so it rallied 5.91%. It's had a really strong first 3 months of FY22. The back end of FY21 was a little bit difficult for this portfolio, but it's credit to you. It's been a really strong performer at the start of this year. What are the highlights in that portfolio over the month, Harry?
Well, there's one clear standout winner, and that's Paladin PDN. Bought that well earlier in the financial year and sold it early in September, actually, for almost double the price. We bought it again later in the quarter at a cut rate price. So we sold mid-90s, bought again in the 70s. We bought Calix, which did pretty well only 2 days after we bought it. That jumped about 20 odd percent. Capital Health, CHA, that's held up okay, added that one in the portfolio. But Coronado, CRN, and Nitro NTO were sort of the standouts. When you look at the portfolio, though, there was 12 positions out of the 20 we held throughout September that actually fell. So we had more falls than gainers, but overall the composition of the portfolio and picking some good ones helped that one rally, like you said, almost 6%, and it's almost up 10% this financial year to date. Moving on to more the international sort of aligned portfolios, the international portfolio itself struggled a bit in September. James, you want to care to comment on that one?
Yeah, you touched on more positions falling in the emerging companies portfolio than rising. That was certainly the case in the international portfolio, the international equities portfolio. That was down 6.28% in September. Not a good result for that portfolio, but you got to keep it in the context of what the market did. Over in the US, the S&P 500 was down 4.79%. So obviously a weaker period over in the US market. Bear in mind, if you cast your mind back to the last day of September, our market rallied nearly 2% on that day. The US didn't. So that's why our ASX 200 dramatically outperformed overseas markets in September. So put that into context. So, a skew towards technology is hurting us a bit in this portfolio. We've written a lot about our belief that value stocks are going to continue to outperform technology as we move into the back end of 21 and into 22. So, we've got to sort of think about this portfolio in terms of the composition we've got in some of these really strong positions that we really like, and it's hard to trim positions that you really like from companies in this technology space. So we will be transitioning that. We've done a few positions over the last couple of months, but we'll transition it slightly away from that tech space over the coming months. But a weak performance in the international equities portfolio, not a hugely out of kilter with the market, and the annual performance in that portfolio still remains pretty strong, Harry.
Yeah, definitely. What a difference a day makes, James. The ETF portfolio is the last one we're going to touch on today. How'd our macro calls hold up in September?
Yeah, so pretty good. I mean, this is a portfolio that you want to do that's sort of not correlated with the traditional equity market. So it holds, commodities and a bunch of other things. It's skewed to. It's got a position in there that benefits from interest rates that go up. It's got a bunch of other positions that should not necessarily be overly correlated to equity. So that portfolio was up in the month 0.22%. Again, it's got quite a bit of exposure overseas and the like. So I was comfortable with the performance of the ETF portfolio. One position we did add, which has done particularly well, is fuel. Energy prices that we've been writing about have been doing particularly well, whether that's coal or oil or uranium is doing, that's been doing really well. So fuel tracks global energy companies. So we added that to the portfolio during the month. And that's done well for us. So we continue to remain bullish that energy space, Harry, and it's going to be a key feature across our portfolios for the remainder of this year at least.
All right, good stuff. Thanks for joining us, James. Good to get an update on performance.
Thanks, Harry.